Hello, thanks for watching. Welcome back to the next video in my series. Now, as usual, a few things before we get started. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. That's way when I upload a new video, you know about it, and it's always nice to connect with my viewers online. If you like the video, please give the thumbs up, share it with classmates or colleagues, or put it on a playlist. That does encourage me to keep making them for you. If you think there's something I can do better, please leave a comment below the video, and I will take those ideas into account when I make new ones. Let's get started.
Here's a breakdown of the accounting process and why it's so important. The accounting process. Accounting involves 3 key steps. 1. Identifying. This is the first step where accountants gather information about financial transactions. These transactions could be anything that affects a business's financial position: sales, purchases, payments, investments, etc. Essentially, it's figuring out what needs to be recorded in the books. 2. Recording. Once transactions are identified, they need to be recorded systematically. This involves keeping a chronological record of each transaction, often using a method called double-entry bookkeeping. This ensures every transaction is accounted for and the books are balanced. 3. Communicating. Finally, the recorded information is presented in a clear and understandable format, usually in the form of financial statements like balance sheet, shows what a company owns, assets, what it owes, liabilities, and the owner's equity at a specific point in time. Income statement shows how much money a company made, revenues, and how much it spent, expenses, over a period of time. Cash flow statement shows how much cash came in and went out of a company during a period. Qualities of useful accounting information. For accounting information to be truly useful, it needs to be 1. Relevant. The information should be relevant to the decisions users need to make. It should help them understand the past, assess the present, and make predictions about the future. 2. Reliable. The information should be accurate, free from errors, and unbiased. Users should be able to trust that the information fairly represents the underlying economic events. 3. Comparable. The information should be presented in a way that allows users to compare it with information from other companies or from different time periods within the same company. This allows for meaningful analysis and benchmarking. The goal of accounting. The ultimate goal of this entire process is to provide useful information to those who need it. This includes internal users, management, employees, and owners who use the information for decision-making, performance evaluation, and planning. External users, investors, creditors, government agencies, and the public who use the information to assess a company's financial health, performance, and compliance. By providing high-quality, useful information, accounting helps users make informed decisions about resource allocation, investment, lending, and more. It contributes to transparency, accountability, and efficiency in the financial world. Accountants are responsible for creating financial reports that cater to 2 distinct audiences: external users and internal users. These reports serve different purposes and contain varying levels of detail to meet the specific needs of each group. External users. External users are individuals or entities outside the company who rely on financial reports to make informed decisions about their interactions with the business. Here are some key external users and how they utilize financial reports. Lenders. Banks and other financial institutions use financial reports to assess the creditworthiness of a company before granting loans. They analyze the company's assets, liabilities, and profitability to determine its ability to repay the debt. Shareholders. Current and potential investors rely on financial reports to evaluate the company's performance and make investment decisions. They look at metrics such as profitability, return on investment, and dividends to gauge the company's financial health and potential for future growth. Governments. Tax authorities use financial reports to determine the company's tax liabilities. Regulatory agencies may also use the reports to ensure compliance with industry regulations and financial reporting standards. Consumer groups. These groups analyze financial reports to assess the company's financial stability and its impact on consumers. They may use this information to advocate for consumer rights and fair pricing practices. External auditors. Independent auditors examine the company's financial reports to provide an objective assessment of their accuracy and compliance with accounting standards. This assures external users of the reliability of the information. Customers. While less common, Customers may review financial reports to assess the company's long-term viability, especially when entering into significant or long-term contracts. Internal users. Internal users are individuals within the company who use financial reports to manage and make decisions about the business's operations. Here's how different internal users utilize these reports. Managers. Managers at all levels use financial reports to monitor performance, identify trends, and make informed decisions about resource allocation, pricing, and production. Officers, directors. Top executives rely on financial reports to make strategic decisions regarding the company's direction, investments, and overall performance. Internal auditors. Internal auditors use financial reports to assess the effectiveness of internal controls, identify areas of risk, and ensure compliance with company policies and procedures. Sales staff. Sales teams may use financial reports to track sales targets, identify profitable products or customer segments, and make informed decisions about sales strategies. Budget officers. Budget officers use financial reports to develop and monitor budgets, track actual results against planned performance, and identify areas for improvement. Controllers. Controllers are responsible for overseeing the accounting and financial reporting processes. They use financial reports to ensure accuracy, completeness, and compliance with accounting standards. Key differences between external and internal reports. Focus. External reports primarily focus on the company's overall financial performance and position for the benefit of external stakeholders. Internal reports delve deeper into specific operational details and may include non-financial information relevant to internal decision-making. Frequency. External reports are typically prepared on an annual or quarterly basis, while internal reports can be generated as frequently as needed, even daily or weekly. Format and detail. External reports follow standardized accounting principles and formats like Generally Accepted Accounting Principles, GAAP, or International Financial Reporting Standards, IFRS. Internal reports are more flexible and can be customized to meet the specific needs of internal users. Confidentiality. External reports are public documents accessible to anyone. Internal reports are confidential and intended for internal use only. By understanding the needs of both external and internal users, accountants can create effective financial reports that provide valuable insights for decision-making at all levels. Here's a breakdown of the opportunities. 1. Financial accounting. This focuses on the big picture of an organization's finances. Preparation. Creating financial statements like balance sheets, income statements, and cash flow statements. Analysis. Digging deep into those statements to understand trends, profitability, and financial health. Auditing. Examining financial records to ensure accuracy and compliance with regulations. Think external audits for public companies. Regulatory. Ensuring compliance with financial reporting standards, like GAAP or IFRS. Consulting. Providing expert advice to businesses on financial matters. Planning. Developing financial forecasts and budgets. Criminal investigation. Uncovering financial fraud and white-collar crime. Forensic accounting. 2. Managerial accounting. This is about using financial information to make internal decisions within a company. General accounting. Recording and summarizing financial transactions. Cost accounting. Tracking and analyzing the costs of production or services. Budgeting. Creating and managing budgets for different departments or projects. Internal auditing. Evaluating a company's internal controls and processes to identify risks and improve efficiency. Consulting. Advising managers on financial performance and decision-making. Controller. Overseeing all accounting operations within a company. Treasurer. Managing a company's cash flow and investments. Strategy. Using financial data to contribute to strategic planning and decision-making. 3. Taxation. This area deals with all things taxes. Preparation. Preparing tax returns for individuals and businesses. Planning. Developing tax strategies to minimize tax liabilities legally. Regulatory. Staying up to date on tax laws and regulations. Investigations. Representing clients in tax audits or investigations. Consulting. Providing tax advice to individuals and businesses. Enforcement. Working for tax authorities to ensure compliance, e.g., IRS. Legal services. Providing legal advice on tax matters. Estate plans. Helping clients with tax-efficient wealth transfer and estate planning. 4. Accounting related. This highlights how accounting skills are valuable in a wide range of fields. Lenders. Assessing the creditworthiness of borrowers. Consultants, providing business advice in various areas, drawing on financial expertise. Analysts, analyzing financial data for investment decisions. Traders, making investment decisions based on financial information. Directors, serving on boards of directors, providing financial oversight. Underwriters, assessing risk for insurance or investment purposes. Planners, developing financial plans for individuals or organizations. Appraisers, valuing assets for various purposes, e.g., real estate, businesses. FBI investigators, investigating financial crimes. Market researchers, analyzing market data, often with a financial component. Systems designers, designing accounting information systems. Merger services, providing financial due diligence in mergers and acquisitions. Business valuation, determining the value of businesses. Human services, managing finances for nonprofit organizations. Litigation support, providing financial expertise in legal cases. Entrepreneurs, starting and managing businesses, using accounting knowledge. This list demonstrates how accounting skills are in demand across many industries. Whether you prefer working with numbers, people, or a combination of both, there's likely an accounting career path that suits your interests and strengths.
Finally, if you like the video, please give it a thumbs up and share it with classmates or colleagues. Please feel free to follow me here on YouTube, Facebook, TikTok, or Telegram. It's always nice to hear from you. If you think there's something I can do better, please leave a comment below the video. So, thank you very much for watching. I wish you the best of luck in your work and studies. I look forward to seeing you again next time.